Foreclosures in Sunbelt cities are up 15% this quarter. Vacancy rates in Miami, Houston, and Phoenix just hit multi-year highs. And institutional buyers? They're circling quietly, waiting for panic to create opportunity. So here's the question. Is this the perfect storm or the next big trap? Because when liquidity tightens and prices wobble, you know how this goes. Cash is king when the market crashes. In this video, I'll show you exactly where the smart money is flowing, which cities are seeing double-digit rental yields, and how to position your portfolio before the next wave of buyers returns. Stay with me, because in a few minutes I'll reveal the 3 best cities to invest in distressed multifamily assets in 2025. Let's start with what's happening on the ground. In 2024, Sunbelt cities like Miami, Houston, and Phoenix experienced a surge in multifamily development. According to CoreLogic, more than 440,000 new units came online nationally, nearly 40% of that in the Sunbelt alone. This rapid expansion collided head-on with a steep drop in inbound migration. Redfin's latest data shows a 25% decline in relocations from New York and California into Florida and Texas since 2022. That shift alone is shaking up rental demand across the region, and it's showing in the numbers. Look at this chart. Multifamily vacancy rates, Sunbelt cities 2023 to 2025. Vacancy rates across key cities have spiked. Miami, 8.2%. Houston, 7.8%. Phoenix, 7.6%. Compare that to just 5.8% last year, and you start to understand why some landlords are offering free rent for the first month again. Now, let's talk about pricing. Look at this chart. Sunbelt rent trends, first quarter 2024 to first quarter 2025. Rents in Miami have declined by 2%, now sitting around $2,600 per month. Houston remains flat at $1,800, and Phoenix has dipped 1.5%. The days of 15% annual rental growth are over, at least for now. And as income growth fails to keep pace with rent, affordability is becoming a serious drag. The National Association of Realtors reports that multifamily affordability is now sitting at an index of 85, well below the neutral level of 100. You know how this works. When rents soften and vacancies rise, the next shoe to drop is usually financing. Multifamily mortgage delinquencies have risen to 4.5% nationally, according to J.P. Morgan, driven mostly by adjustable-rate mortgages from 2021 and 2022 that are now resetting above 7%. Adam Data reports that multifamily foreclosure filings are up 15%, with over 3,000 new cases emerging in Q1 alone, concentrated in Florida and Texas. And consider this. Foreclosure filings, Sunbelt Multifamily Q1 2025. These aren't single-family homes. These are entire small apartment buildings being handed back to lenders, often by over-leveraged developers or syndicators who couldn't keep pace with rising debt service. But here's what most investors overlook. This isn't a systemic collapse. It's a regional rebalancing. The fundamentals of population growth, job creation, and tax-friendly policies still support long-term demand in the Sunbelt. What we're seeing now is a repricing of risk, which opens the door for liquidity-driven investors. And that brings us to opportunity. If you're sitting on cash or access to it, you are at a clear advantage in today's market. From what I've seen working with private investors across Houston and Miami, the sweet spot right now is 1 to 3 million multifamily assets. Properties too small for BlackRock, but too big for the average individual investor. Zillow data shows that distressed assets in that range are now trading at 15 to 20% below market, especially where sellers are facing loan maturities or floating rate resets. Here's a real-world example. A client of mine recently closed on a $1.6 million 8-unit complex in North Houston. The property had been listed at $1.95 million in 2023, but sat idle due to failed financing and falling rents. He paid cash, closed in 10 days, and immediately re-tenanted 3 vacant units with moderate upgrades. Today, he's generating $6,400 per month gross and targeting a 5.8% net yield with full upside when rates start to fall. Compare that to institutional moves. Greystar, one of the largest multifamily players in the U.S., recently acquired 800 units across Miami and Phoenix at 18% below market, financing 75% of the purchase with cash. Their strategy? Lock in 5.7% yields, invest in CapEx, and ride the 2026 rebound. Now, you may not be Greystar, but with $2 to $4 million in liquidity, you can mirror that model on a smaller, faster, more agile scale. Let's dig deeper into why this model works right now. Look at this chart. Sunbelt inventory supply, 2023 versus 2025. Markets like Miami and Phoenix now have over 6 months of inventory compared to just 3.5 months pre-COVID. This gives buyers leverage, not just on price, but on terms, concessions, and closing timelines. And for international investors, the currency tailwinds are real. If you're in the UK, a $1.5 million deal in Miami converts to just over £1.14 million, a bargain compared to similar London properties. For Australians, it's roughly 2.3 million Australian dollars, often for properties yielding twice what you'd find in Sydney. Just be mindful of FIRPTA for US exits, CGT in Australia, and SDLT if holding through a UK trust. Later in this video, I'll tell you which Sunbelt cities are expected to lead the recovery wave and which still face oversupply risk. But here's the broader playbook investors are quietly using now. Target small to mid REOs. Focus on 8 to 20 unit properties in strong submarkets. Look for undermanaged assets with physical deferred maintenance, not economic collapse. These are easier to fix and reposition. Negotiate seller concessions. In Q1 2025, over 30% of Sunbelt deals closed with some form of seller concession, ranging from CapEx credits to interest rate buy-downs. Use creative structuring. Sellers facing refinance cliffs may accept delayed closings, leasebacks, or even partial seller financing. These aren't distressed sellers. They're trapped by rate cycles. Time the capital stack. Rates are expected to soften into late Q3 or early Q4 2025, per the Fed's own forward guidance. Look at this chart. Vacancy rate versus price movement. Q3 forecast 2025. As vacancy peaks and debt becomes cheaper, cap rates will stabilize and pricing will find a new floor. And when that happens, institutional capital will re-enter. But by then, you'll be sitting on assets acquired at 2020 level pricing with 2026 level rents. That's how smart money plays the middle of the cycle. Not the bottom, not the top, but the inflection point. So whether you're investing from Texas, Toronto, Sydney, or Surrey, the U.S. multifamily market right now is not about panic. It's about precision. Are you building liquidity, watching specific metros, or already placing bets on recovery plays? Stay tuned, because next, I'll walk you through the 3 top-performing Sunbelt metros for yield, value, and upside in 2025. And before we wrap up, I want to leave you with one last strategy that's proving surprisingly effective for investors in 2025, even in a declining market. It's what I call acquire before the absorption, positioning early in submarkets where oversupply is just starting to clear, but sentiment is still negative. You're not chasing rebounds, you're anticipating them. Take Houston's Spring Branch or Phoenix's East Valley. These areas have high inventory now, but look at this chart. Housing inventory versus buyer demand, Sunbelt 2024 to 2025. Buyer demand is beginning to creep back up as affordability improves and financing becomes more accessible. From what I've personally seen working with investors in Florida and Texas, the ones who act early, while others hesitate, are the ones who walk into recovery already owning the assets everyone else wants. You know how fast things move in this market. Waiting too long can cost you, not just in missed returns, but in missed control. So let's recap the key takeaways from today's video. First, vacancy rates are climbing, but they're creating openings, not just risks. Second, institutional capital is already back, albeit quietly, watching for the retail investor to miss the window. Third, cash buyers and nimble players have the edge right now, especially in the $1 to $3 million range. Fourth, cross-border investors from the UK, Australia, and Canada can leverage both currency and timing advantages, but need to plan for tax on exit. And finally, the true recovery likely starts in the third quarter of 2025. So your positioning in the next 90 to 180 days could make all the difference. Acting now means locking in yield before rates drop, prices firm, and competition floods back in. Delaying may mean watching the best opportunities get scooped by faster players with better information. So let me ask you, which U.S. housing market do you believe has the strongest upside in 2025? Are you actively buying or still watching from the sidelines? Let me know in the comments. I read everyone. And if you don't want to miss the next wave of profitable real estate opportunities in the U.S. and beyond, hit that subscribe button now. Like this video if you found it valuable, and share it with someone serious about building wealth through real estate, because at EstateScope, we don't do noise, we deliver strategy. I'll see you in the next deep dive.